Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Thursday, May 16th, 2024. Initial jobless claims came out a little higher than expected. The S&P 500 is looking as bullish as can be, but there's a few cracks under the surface. The first crack I heard on Gareth Soloway's Trading the Close show today. He mentioned how today's volume in SPY, it's an ETF that trades the S&P 500. He said it had the lowest volume he has seen in one trading day for several years. This is very significant because it just means that even though this chart looks very, very bullish, when you have volume drying up, liquidity drying up, in other words, very, very few people are actually trading here. The normal players that are doing their bids and their sells and their shorts and all of this stuff, they're staying away right now. They're sitting on their hands. They are not trading. He said that it was something like 9 million shares sold today. Normally you get to 10 million by 10:30 in the morning. Markets are open from 9:30 until 4 every day. And that usually you get more than that in the first hour. And if you don't, that's like an alarm bell. Like, why isn't anybody trading? And so, you know, that's not the only crack, by the way. HYT, high yield corporate, is showing a fairly engulfing candle now. Excluding Tuesday, it engulfed Wednesday, Monday, and then from the previous week, Friday, Thursday, Wednesday, Tuesday, and Monday, and the previous Friday. So it engulfed a heck of a lot of candles to the downside. This is a very scary looking red candle, and it suggests fairly strongly that this market wants to go down here. So if high yield corporate is finally, losing its legs, the stock market doesn't really have much of a chance of holding its legs up either. Additionally, XHB, this is the Home Builders Index. We've been seeing quite bullish movement, higher high, higher low, higher high, higher low, higher high. I'm not sure if this counts as a lower low than this candle, but it's starting to look, a candle this large is starting to look like it's breaking this pattern if you draw it in a number of ways. Again, XHB Home Builders Index, this is another decent leading indicator of stock market. The NASDAQ triple Qs, I've been talking about how you have this inverse head and shoulders here and how it just looks as bullish as can be after we broke out of this trend line. And but based on, here on Robschild, we got to use our crystal ball and combine data. We can't just use one piece of information. This super low volume thing scares me a little bit. The truth is, though, is that smarter traders or money, the people that are normally trading this, they're waiting for something. I'm not sure what exactly. Maybe they're waiting for it to just keep going higher. It's like, for me, I don't know if I envision this into my crystal ball. I kind of see like a firework shooting up into the air. The market, and it's shooting up, and we're like, with the volume drying up, it's like we're running out of ammo here. It's just slowing down, and then what happens? Well, I'm still a bear. Again, the Fed's strangling the economy. They haven't started loosening. They kept tightening until they're like, okay, or I have our hands around the neck tight enough now. Let's see what happens. And they've been holding it there and waiting. And don't fight the Fed. Rates with being this high, unemployment is going higher and higher. underemployment's going higher and higher. Credit card debt is skyrocketing. Bank accounts are getting low. This is the signs are here. The signs are here. As I mentioned, so the bond market is considered to be smart money, and the treasury bond market of the US dollars, in my opinion, is probably the smartest of the smartest money. And when you see yields collapsing here, it's like it's twofold. It's to get the full story, as I said yesterday, and I'll repeat now. When yields drop, they automatically let stocks go up in price, because the amount of earnings that a stock can make, when the yields are going down and the values of the treasuries are going up, a company doesn't have to make as much money for its valuation to automatically be levered up. And so when yields drop, stocks can go up. However, when stocks start collapsing and people start selling and running to safety, they go into these same treasury bonds, pushing yields even lower, making the value of the treasuries going up. And so that's why, again, they've I said in the last video, the last 5 years, they seem treasuries seem way oversold, but it's more like within the last like 10-15 years, that time range. Sorry about the error. The point is that I'm happy to not be involved with stocks very much, and actually I'm considering at this point even deleveraging even more in stocks. I've been talking about how I'm long China, Brazil, and REMX because they seem undervalued for so long, but with China ripping up and having a decent rip recently, I'm having to actually chop off some to maintain the 10%, but I'm considering at this point, especially with the fragility going on in the US markets, the thing is, as uncorrelated as markets can be sometimes, in an all-out like very bearish market, especially in the S&P 500, which I expect, it tends to bring all stock valuations down with it. And so I am starting to think about deleveraging even more in all of my stock positions. Again, I'm 49% exposed currently to treasury bonds. Some of it's got leverage with a TMF fund, the rest of it's 0Z. Very similar to TLT, longer duration, more sensitive to interest rate changes, and cash. And so I'm only like 25% equities, but I'm considering even getting rid of all of that actually at this point. But I'm gonna have to think about it a little more before I make any really big moves. Yeah, so for today, that's all I got. Hope you enjoyed. Thank you for watching. Robschild.